Hello everyone! This webinar is provided to you by the Axnis company. My name is Stanislav Bernuhov. I'm a full-time trader with more than 11 years of experience for the present moment, and today I will be a host in this webinar. I remind you that you can open a trading account with Axnis company by the link that you see in the general chat. You can click it and open an account with simple steps listed on a web page. The topic of this webinar is Top 5 Habits of Successful Traders, and today I will speak about something that distinguishes professional, consistently winning traders from the amateurs. Of course, you should have a winning strategy, manage your capital, and so on and so forth. But are there habits that really make a good trader? Let's try to discover it together. I suggest you to listen to the information and make notes if necessary, and if you have any questions, you can ask all of your questions in the end of this webinar. And now we are ready to start. Before we start, let's take a quick look at the disclaimer. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial, and you will accept full responsibility for any of your trading decisions. Past performance is not a guarantee of future returns. And the first question is, can success be measured in profit? After all, we are here for profit. And too often, quality of trading is measured by short-term trading results. They say if you make money today, you can be called a good trader. There are several serious weak points in this concept. First of all, you can earn money by the fact of simply increased leverage. Prices don't typically move 5% a day, and average magnitude of price action is not very big, so traders have to employ leverage. The more leverage you employ, the more money you can earn and a greater potential risk you have in your trades. So you can show short-term results just due to increased leverage. It can lead to potentially large drawdown later, so it is not possible a sign of a very good trading. Also, you can earn quick money moving stops, averaging your losses and doing other destructive actions that increase risk of ruin for your account. Secondly, you can achieve short-term results employing extraordinary market conditions. Sometimes markets move very quickly and show very big magnitude. And some traders capture big profit within such days, but they can't produce anything when markets are moving in normal mode with average volatility. So how can we else measure quality of trading if not by the short-term result? Here in this slide I have placed 5 habits of successful traders that I treat as most important ones. And the habit number 1 is controlling your risk. It is very difficult to find a trader which is disciplined in risk control because it is not very comfortable psychologically to cut your losses, to have stops. And in my point of view, risk management can't be reduced just to stop placement. It is much more than just placing a stop. Risk management is also ability to estimate the odds. But if you can control and limit your risk, it is really the foundation for good trading. If you don't have this, nothing will help. If your analysis is not very good, it may not be very harmful for your trading. But if your risk management and risk control are unstable, you will have very modest odds of success, if not to say that you will have increased odds for a failure. Habit number 2 is ability to widen your perspective for profit. In other words, it is letting your profits run. Habit number 3 is keeping a journal. If you want to really become a successful trader, you have to keep a journal. Habit number 4 is analyzing your trading log, which is a source of valuable information about your trading. If you want to know yourself, you have to make a research. All successful traders analyze their trading logs on a consistent basis. They know what to look at. They know how to decipher their logs and capture important information. And finally, habit number 5 is building supportive trading environment. It is often overlooked by the majority of traders, and we will touch this topic throughout this webinar. When you analyze anyone's trading account or even your own trading account, the first thing that you have to notice is ability to control risk. Does trader have certain rules for managing losing position? Too many times I was observing trading accounts where trader was not fixing any losses, but was fixing profits. In other words, trader was not managing losing positions, letting losers run. For some period of time, losing trades may turn into winners if you don't manage them. Markets tend to rotate 80% of the time rather than being in a trending condition. But eventually such kind of behavior is very dangerous and may lead to a ruin of entire trading account. On this slide you see the performance backtest of mean reversion strategy that didn't include any stop loss. You may notice that such kind of strategy may generate stable profit for some period of time, but eventually it loses the entire account. So if I look at the trading log or a trading report, first thing that I seek for is quality of risk control. Here you see the example of trading report of one of traders who had sent me it for analysis. I don't know whether you see numbers here or not, but I want to pay you attention at increased losses on the gold. As it is trading account, losses and gains are not very big, but you may see that typical loss is equal to $2 or $3, and the loss for the gold is equal to around $7, which is 2 times greater. I would say that this is a dangerous sign, and first I would ask a trader, why do you have such difference in results? Maybe he employs another strategy in gold, I don't know, so I have to ask. But if strategy is just the same for gold as for any other trading instrument, it means that the quality of risk control is not very good for this trader. Many traders allow to have increased losses due to very popular issues of moving and canceling stops. The reason lies in the psychological field. When we focus too much on negative results, we easily remember situations when market had taken our stop just to move in the direction that we predicted previously. It is pre-default feature of our brain to focus on negative outcomes 2.5 times greater than on positive ones. The more risk we take, the more leverage we employ, the more we will focus on negative situations. We may just don't remember situations when our stop loss prevented us from getting big losses. One trader which I know had said that every time he enters a position, market immediately goes against his position. I suppose that it might not be necessarily truth. They definitely were the situations when market generated profit immediately after he entered the position. He just didn't pay too much attention to this situation, so he experiences difficulties with trading discipline. Eventually he was not placing any stops in the market, thinking that once he places a stop it will be executed. He had lost very much money doing so. Now he understands the importance of risk control. But he paid very high price for that understanding. The lesson was very expensive. The second habit that correlates with trading success is ability to let your profit run. It may sound like a banality and just an old adage, but in reality it is really a habit that many successful traders develop over time. From time to time market can generate significant volatility, and it is not very rare event today. On this chart you see at least 2 big days from a chart of American dollar versus Japanese yen. I am not saying that such kind of days are predictable, but if you let your profits run, you may capture such volatile swings, positioning yourself on the right side of the market. Think about this habit as the opposite for another habit. Most of traders move stops. When price goes against their positions, they move stops, trying to get away from losses. If you do exactly the opposite, moving your take profits instead of your stop losses, you may find that you can achieve surprisingly good results. Of course, it must not be done blindly like it is shown here, but the principle is pretty much the same. You move your take profits instead of stop losses. To make things done correctly, you can basically do several things, like using trailing stop or fixing your profits partially. As for me, I prefer the second. When you trade within a day or within a period of 2 to 3 days, it is not very good decision to place tight trailing stop. Markets often retest previous important levels before going in a direction of a trend. So if you use a trailing stop or break-even stop, you may be thrown out of a good position very quickly. But if you divide your targets on several parts, it might be a better decision than placing your stops to break even. For example, you have the first target, which is average, and you have second target, which allows you to let your profit run. For example, you may decide not to close your profit until the day ends. Also, you can rely on historical volatility, which is measured by the average true range indicator. I use 21 parameters for ATR for 30-minute chart. When volatility is at the lowest value for the period of 1 to 2 weeks, it increases the odds of a big day to appear, just like it is shown here on this slide. Notice that normally volatility is the lowest before European session starts. It can allow you to position yourself at the right side of the market pretty early. Here is another example from Japanese yen. You see here that big market moves are preceded by the lowest value of the ATR. Of course, successful trades cannot be mechanical. You have to take into consideration many other parameters and analytical clues. But if you see the lowest volatility for pretty long period of time, you may decide to have extended targets, which will mean that you let your profit run in the right place at the right time. It is not enough to let your profits run because you just want to get a big profit. You also need to know when this big profit is about to appear, and here analytical clues come into play. And habit number 3 is keeping a journal. Traders with experience more than 3 decades are consistent with keeping a journal. On the one hand, they already know intuitively many setups for good trades. On the other hand, they write down all their thoughts in a journal. And if you want to become one of those professional traders, the earlier you start to journal, the better. Trading journal is not just a trading log or a trading diary. It is a combination of 3 things. The first is analytical part of your journal where you fix your thoughts about the market. The second is the general diary when you put your thoughts and feelings and behavior. And the third one is pure statistics with a trading log. Of course, you have to link all parts of your journal together to get holistic view on your trading. I recommend you to distinguish facts from interpretations when you write down your ideas about the market in analytical part of your journal. Traders too often very quickly make interpretations, missing some facts of other important nuances of information. When you develop a habit of distinguishing facts from interpretations, you are about to make fewer mistakes in a process of building trading ideas. What is a fact? When you see new lows and highs 3 days in a row, it is a fact. When volatility is the lowest for a certain period of time, it is also a fact. But if you say that the market is trending, or the market is weak, or the market is strong, you are building interpretations. The idea here is to analyze interpretations and see whether they are based on correct information. In general diary, you can fix your emotional background in the now moment. In other words, you may start questioning yourself. What am I feeling right now? What do I normally do after feeling so? Do I want to get in a trade? Do I feel anxiety or boredom? Did I have winning or losing day yesterday? When you ask yourself such questions, you start focusing on your recent emotional background. Eventually, your emotional intelligence and self-awareness increase. It is a very important part of a trading journal because self-awareness is a real key to a trading discipline. And habit number 4 is analyzing your trading log. When you download your trading report from your trading terminal, you just see a sequence of numbers. They don't tell you any story unless you start deciphering it. Let's try to do it using trading report that you see here on this slide. It is a report from small trading account that might be interesting for analysis. One trader sent me this report asking me to analyze it, so I will try to do it briefly right now. I use special web service named MarketStat for the sake of analysis, but you can use Microsoft Excel for that purposes. First question that we can ask is whether our performance is similar for every instrument traded. In this example you see that only gold had generated positive result, while all other trading instruments have not generated anything. It is possibly a sign that trader has to eliminate the majority of his trading instruments and focus on 2 to 3 trading instruments at a time. Such situation is very common among short-term traders. They take too much instruments without being able to focus on 100% of them. Therefore, they generate much activity that doesn't make sense. What else can you capture analyzing your trading log? For example, you can build a distribution of results comparing it with the number of trades within a day. In this particular example, you see that best trading results are achieved with 2 trades or even 1 trade a day. In other words, the less you trade, the more money you make. What about size of your position? And again, in this example, we see that good results don't correlate with big size of the position. When you don't analyze your trading log, you might not see this. It doesn't mean that size of position cannot correlate with positive result at all. It just means that it is the truth for the given trader and for given trading report. And finally, you can build a normal distribution of your trading. If you use Microsoft Excel, it can allow you to build such distribution as well as with any other analytical software of this kind. Here you want to see that the distribution is more elongated to the right side rather than to the left side. It is truth for the current trading report. The right side of the distribution the right side of the distribution is the profitable side. So the more green bars you have, the better. And finally, to trade successfully, you need to build supportive trading environment. What do I mean by that? We all operate in some environment. Our family may be skeptical about our trading and it may affect our results. We may not have enough reserved cash, so that we might experience anxiety and pressure in case we can't produce profits by the end of the month. We may not have enough time for preferred trading style. All those things create our environment. So you will have to realistically estimate whether you have what it takes to become a professional trader. Or maybe you will trade part-time unless you will gain enough experience and build up a trading capital. And with that, we are coming to an end of our webinar. Thank you for listening. Now, if you have any questions, you can ask them and I will do my best to give you the answers. Okay, I'm now ready to answer any questions, so feel free to ask. I will do my best to answer. There are many traders that I follow that I was following, but my favorite trader is Jim Dalton, who is author of the book Markets in Profile, and also it is Peter Brandt, who is the position trader. Trading on long-term charts, but there are many traders. What is my hobby? Oh, I see. I like music and traveling, so I have a music band, so I play in the band on the keyboard, and I like to travel. How do I combine trading with those hobbies? Well, trading is pretty flexible occupation, so I can choose my trading style. I am not stick to the table 8 hours a day, so I can do many other things when my position is in the market. Do I want to write a book? Is the question. Yes, it is in my plan. So now I'm working on the book. It is moving pretty slowly because I trade a lot, I make webinars, but eventually I think that I will release a book with my ideas, concepts and methods of trading. Well, it will be on English. Thank you for the answer. I started to trade full-time and earn a living with trading in 2008, after the world financial crisis, when markets were falling and I was able to earn enough capital to increase my capital to start to trade for a living. I'm trading since 2004, but it has taken me around 5 years to build my trading style, to start trading consistently and earn for a living. I wish everyone good trading, manage risk, control your risk, and remember that we are not here for quick profits. We are here for long-term success, for long-term results.